Hello, everyone, and welcome back to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president, and it is our sincere, genuine, full pleasure and honor today to host Governor Waller for his first speech to the public as a member of the Board of Governors of the Federal Reserve System. Governor Waller will be speaking on the issue of central bank independence, critical issue at every time, but in particular at this time of very large-scale fiscal action, where a lot of attention has been focused recently. We're looking forward to hearing from Governor Waller shortly. If I can just briefly say, we're very privileged at the Peterson Institute this week to continue to be a key forum for discussion and presentation by leading monetary and financial economists and leading economic policymakers. Following today's speech by Governor Waller, tomorrow morning at 9 a.m. Washington time, we will have Vice Chair of the Board of Governors, Randall Quarles, speaking in his capacity as Chair of the Financial Stability Board, talking about the international financial stability issues. On Wednesday, March 31st, we will have Augustin Carstens, the General Manager of the Bank for International Settlements, the leading monetary economist and former Governor of the Bank of Mexico, making a major speech on central bank digital currency. And on Thursday, April 1st, my colleague Karen Dinan, professor of the practice of economics at Harvard and non-resident senior fellow at the Peterson Institute, will present our latest semi-annual global economic prospects, followed by some brief remarks by me on whether we have, perhaps in light of the speeches this week, reached a turning point or a regime shift in monetary policy globally. We appreciate all of our audience joining us for what we're now calling at the Peterson Institute. And we hope that you and others will continue to sign in. You can view these events live on www.PIIE.com or register. And you can submit questions to our speakers over meetings at PIIE.com. But each event is important on its own, and certainly no more so than today, Governor Waller's speech on central bank independence. I want to congratulate Governor Waller. Chris took office as a member of the Board of Governors just 3 months ago on December 18th, 2020. And he is, prior to his appointment at the board, he was the Executive Vice President and Director of Research at the Federal Reserve Bank of St. Louis since 2009, leading their efforts along with President Jim Bullard in a huge number of influential publications and system contributions. In addition to his experience in the Federal Reserve System, Dr. Waller has been a distinguished academic contributor as a professor in the Gilbert F. Schaefer Chair of Economics at the University of Notre Dame. He was also a research fellow with Notre Dame's Kellogg Institute for International Studies. From 1998 to 2003, Dr. Waller was professor in the Carol Martin Gatton Chair of Macroeconomics and Monetary Economics at the University of Kentucky. I met him when he was a research fellow as well at the Center for European Integration Studies at the University of Bonn. Dr. Waller received his BS in economics from Bemidji State University and an MA and PhD from Washington State University. He brings this wealth of experience, academic insight, and policy advice to his new role as one of the voting members of the Federal Open Market Committee and a member of the Board of Governors of the Federal Reserve Board. Again, thank you, Chris, for joining the Peterson Institute audience with your first public speech. We look forward to your remarks.
Thank you, Adam. I appreciate you hosting me today for this speech. By way of introduction, I spent the first part of my career as an economics professor and researcher. One of my main fields of inquiry was monetary policy theory, and I've long been a strong believer in the virtues of central bank independence. And today I will devote my remarks to that topic. Some of my friends tell me that central bank independence seems to be the only thing I ever talk about. As a result of the COVID crisis, tremendous monetary and fiscal measures have been taken to provide economic relief to American households and businesses. The Federal Reserve took a host of actions, including lowering its policy rate to zero and purchasing securities to support market functioning and provide monetary accommodation. The Congress enacted several packages that funded the health response to the pandemic, expanded unemployment insurance, and provided economic assistance payments to households and businesses. The virus also created uncertainty and turbulence in financial markets, which led the Federal Reserve to establish emergency lending programs to serve as lending backstops and support the flow of credit to households, businesses, nonprofits, and state and local governments. Establishing these programs under Section 13.3 of the Federal Reserve Act required substantial cooperation between the Department of the Treasury and the Federal Reserve. The Congress has provided spending of roughly $5.8 trillion during the last year to deal with the pandemic and its effect on the economy. This action has pushed the ratio of publicly held U.S. debt to nominal gross domestic product to more than 100% for the first time since World War II. The Federal Reserve's holdings of U.S. government debt has risen to around $7 trillion, with about $2.5 trillion of that total resulting from its asset purchase program aimed at smoothing credit market functioning and providing monetary accommodation. Because of the large fiscal deficits and rising federal debt, a narrative has emerged that the Federal Reserve will succumb to pressures, one, to keep interest rates low to help service the debt, and two, to maintain asset purchases to help finance the federal government. My goal today is to definitively put that narrative to rest. It is simply wrong. Monetary policy has not and will not be conducted for these purposes. My colleagues and I will continue to act solely to fulfill our congressionally mandated goals of maximum employment and price stability. The Federal Open Market Committee determines the appropriate monetary policy actions solely to move the economy towards those goals. Deficit financing and debt servicing issues play no role in our decision-making and never will. Chair Powell made the same point in his recent comments to the Economic Club of New York. My objective today is to reinforce that message. This does not mean, however, that the Treasury and the Federal Reserve should never work together. My comments today will focus on the issue of cooperation, on when and how much is beneficial, and on the potential costs that should not be overlooked. Let me point out that there are two fronts for interaction between the Treasury and the Federal Reserve. The first is what I will call back office operations. By this term, I mean the range of fiscal agency services that the Federal Reserve provides to the Treasury by statute. For example, the Federal Reserve maintains the Treasury's operating account, accepting deposits, paying checks, and making electronic payments on behalf of the Treasury. It provides security services on behalf of the Treasury, supporting the auction, issuance, and redemption of marketable Treasury securities. It also provides application development and infrastructure support services, assisting in the Treasury's efforts to improve government cash and debt management processes. The Federal Reserve is the fiscal agent for the Treasury, and to play that role efficiently and at low cost, the Federal Reserve and the Treasury must always work closely together on operations issues. The second form of interaction involves the Treasury and the Federal Reserve working together on certain macroeconomic policy issues. I will discuss two areas where differing degrees of interaction could occur: emergency lending facilities and economic stabilization, and one area where that interaction should not and does not occur, which is debt financing. First, let me talk about emergency lending facilities authorized by Section 13.3 of the Federal Reserve Act. During a financial crisis or extreme market malfunctioning, cooperation between the fiscal and monetary authorities is imperative. An important role of a central bank is to step in and provide liquidity to ensure market functioning during those unusual and exigent circumstances. And under those circumstances, since the passage of the Dodd-Frank Wall Street Reform and Consumer Protection Act, the Secretary of the Treasury is required to approve any new programs under the Federal Reserve's Emergency Lending Authority. As I mentioned, the Federal Reserve and the Treasury undertook this kind of coordinated response a year ago, as uncertainty about the economic effect of the virus caused markets to begin seizing up. Many Section 13.3 facilities were established to support the flow of credit to households, businesses, and state and local governments. All of these emergency programs required the approval of the Secretary of the Treasury, and many of them were supported by the Treasury's financial backing, using funds specifically appropriated by the Congress for these facilities in the Coronavirus Aid, Relief, and Economic Security Act. At times like these, cooperation between the fiscal and monetary authorities strengthens financial stability. A financial crisis is not a time for uncooperative behavior from either side. However, with regard to the second area, economic stabilization, it is imperative that the central bank remain independent from the fiscal authority. There are sizable costs if cooperation turns into fiscal control. To understand this point, consider a situation where the economy is hit with a negative shock that depresses aggregate demand. The Macro 101 textbook policy response we teach our students is for the monetary and fiscal authorities to enact stimulative policies to increase aggregate demand. This effort involves fiscal actions, such as increasing spending and cutting taxes, which increase the deficit. The finance ministry's job is to finance the deficit that results from these fiscal policy actions. Greater borrowing by the finance ministry to finance these policies will tend to put upward pressure on interest rates, which crowds out private sector spending. In this textbook example, the monetary authority should respond to this upward pressure on rates by adopting a more accommodative policy stance to bring rates back down. Now, from an institutional design viewpoint, what would be the appropriate arrangement to ensure this type of policy response? Well, one obvious solution would be to give the finance ministry control of monetary policy to ensure a coordinated policy response. This logic suggests that central bank independence is actually an impediment to optimal stabilization policy. So why have an independent central bank? Why create an impediment to socially beneficial cooperation? In the situation where monetary policy is under the control of the Treasury and thus the executive branch in the United States, political motivations may influence decisions. To return to my stabilization example, as the economy recovers, with all the monetary and fiscal stimulus in place, this stimulus may lead to undesirable inflation pressures. The standard monetary policy response is to evaluate current employment and inflation situations and raise rates when deemed appropriate. However, if monetary policy is under the control of the Treasury, then to further juice the economy for short-term political gains, this action could be delayed past the date the central bank would want to raise rates. Consequently, the argument goes that a hot economy can cause substantial inflation pressures that are hard to rein in politically and which ultimately harm Americans in the longer run. This view is backed up by the political economy literature, which argues that having monetary policy under the control of political authorities may lead to excessive inflation and economic volatility that is not socially optimal. Put another way, it can lead to an unstable economy on which households and businesses cannot rely. Subsequent academic research, including my own, focuses on ways in which the central bank could be designed to prevent this undesired outcome from happening. One of those ways is delegating decision-making to a policy committee that is insulated from short-term political pressures. Institutional details that enhance insulation include giving central bankers long terms and prohibiting removal from office for political reasons. This literature provides the theoretical foundations for central bank independence and the importance of central bank credibility. A look across countries is instructive. Operational independence with clearly specified goals for monetary policy has become the norm for central banks in advanced economies, reflecting the consensus that has emerged over the past 30 years concerning the benefits of central bank independence. The Congress was fully aware of the potential misuse of monetary policy for political reasons, and it purposefully created the Federal Reserve as an independent central bank. The design features of the Federal Reserve minimize political influence over monetary policy while still maintaining accountability to the Congress and the electorate for its policy actions. Eventually, in 1977, the Congress mandated that the Federal Reserve conduct monetary policy to effectively promote the goals of maximum employment and price stability. By having monetary policy overseen by independent officials, the incentives to misuse stabilization policy for partisan purposes is reduced. Monetary policymakers can focus on what is best for the economy over the long run. Finally, we come to the third area of potential interaction between the central bank and the Treasury: debt financing. When governments run up large debts, the interest cost of serving this debt will be substantial. Money earmarked to make interest payments could be used for other purposes if interest rates were lower. Thus, the fiscal authority has a strong incentive to keep interest rates low in this situation. The United States faced this situation during World War II. Mariner Eccles, who chaired the Federal Reserve at the time, favored financing the war by coupling tax increase with wage and price controls. But ultimately, he and his colleagues on the FOMC concluded that winning the war was the most important goal, and that providing the government with cheap financing was the most effective way for the Federal Reserve to support that goal. So the US government ran up a substantial amount of debt to fund the war effort in a low interest rate environment, allowing the Treasury to have low debt servicing costs. This approach freed up resources for the war effort and was the right course of action during a crisis as extreme as a major world war. After the war was over and victory was achieved, the Treasury still had a large stock of debt to manage and still had control over interest rates. The post-war boom in consumption, along with excessively low interest rates, led to a burst of inflation. Without control over interest rates, the Federal Reserve could not enact the appropriate interest rate policies to rein in inflation. As a result, prices increased 41.8% from January 1946 to March 1951, or an average of 6.3% year over year. This trend and efforts by then Chair Thomas McCabe and then board member Eccles ultimately led to the Treasury-Fed Accord of 1951, which restored interest rate policy to the Federal Reserve. The purpose of the accord was to ensure that interest rate policy would be implemented to ensure the proper functioning of the economy and not to make debt financing cheap for the US government. The upshot of these examples is that cooperation between the Federal Reserve and the Treasury is important to address macroeconomic policy issues. But research shows that to avoid distortions in using monetary policy for deficit financing, it is important to have an independent central bank with a clear and credible inflation target, which the Federal Reserve does. Central bank independence is critical for maintaining that target and keeping inflation expectations in line with that target. My message today is that the Federal Reserve and the Treasury should work together at key times and along certain dimensions. Back office operations are done efficiently and effectively in this manner. And in times of crisis, coordination allows policies to be implemented quickly and forcefully to set the stage for a strong path of recovery. But for this arrangement to work, the political independence of the Federal Reserve is essential. It is the best way for the Federal Reserve to meet its congressional mandate and allow policymakers to meet the long-term needs of the American people. The Treasury and the Federal Reserve both recognize this necessity and have issued joint statements to this effect in the past. With this independence, of course, the FOMC is committed to being accountable and transparent about our actions to both the Congress and the public. And the Federal Reserve strives to continually improve its transparency. In 2020, for example, the FOMC released a new statement on longer run goals and monetary policy strategy. This new framework explains how we interpret the mandate that the Congress has given us and describes the broad framework that we believe will best promote our maximum employment and price stability goals. Going forward, the monetary policy choices of the FOMC will be guided solely by our mandate to promote maximum employment and stable prices. These congressionally mandated goals always drive our decisions. Partisan policy preference or the debt financing of the Treasury will play no role in that decision. Cooperation in times of crisis, like during the initial phases of the COVID crisis, was crucial for staving off an economic disaster and putting us on the road to recovery and helping to avoid long-run scarring, and was the appropriate way to serve the Fed's dual mandate. But the independence of the Fed is in the nation's best interest and should be valued and protected by all. Thank you.
Thank you very much, Governor Waller. Clearly, you have a message to get across, and it came across very clearly. And as you said, it relates to topics on which you've been deeply involved for a long time. If I could ask you a few follow-up questions, please.
Sure.
First off, you characterized the historical period of World War II when the Fed was restricted in interest rates. Those were given over to the Treasury until 51. But the restrictions on the Fed started, I believe, before World War II in terms of the actual limits on interest rates. So two questions on that. First is, how much do you think, you present it as though Eccles and others decided it was a right thing to do. How much was this them making the best of a bad situation imposed on them? And then less historically, more currently, what happens if a future Fed or another central bank decides that pursuing climate change goals are the right thing to do, are the multi-year crisis, and therefore they should subordinate to the Treasury? I mean, how do you see a decision like that taking place?
Yeah, so in terms of the details that you mentioned prior to the war, I would have to think back on that a bit. The critical thing is, in a crisis like the Second World War, there is going to be some cooperation between the Fed and the Treasury. The Fed cannot sort of stand in the way of the nation's effort to fight the war. Now, in terms of something like climate change, that's Congress's job. Congress has the responsibility for dealing with policies towards that end. We just worry about maximum employment, inflation, price stability. We study how climate change could impact the economy in ways that would affect us achieving those goals, but the direct impact of climate change, that would have to come through orders from Congress, basically, to respond to it in some particular way. So all we do is we study it, try to understand its impact on the economy and what that would imply for both economic stabilization or regulatory actions.
From the point of view of the central bank, generically, not just the Fed, responding to fiscal policy, does it matter how you respond if the legislature, the US Congress, sets out a multi-year plan or defines this is public investment on climate change or infrastructure, this is discretionary spending? Do those kinds of distinctions matter to a central bank setting its monetary policy?
I mean, the way we approach things is we just take the fiscal policy as given for whatever reason the Congress wants to and the president wants to choose a course of policy action. We take that as given, and then we just take its impacts on the economy into account. So we don't try to actually promote a particular action or say whether it's good or bad. It just, that's the action that's been taken for congressional reasons, and we just go with it. It's not our job to fight back or push back on these things or to try to enact policies that aren't in the interest of the Congress.
But I'm sorry, I don't mean to belabor this, but I meant it sort of the other way around. Congress comes to you and says, here, we have a separate spending pool that is investment, not spending. We want you to not offset that? I mean, what happens when Congress says that in a hearing, say?
Well, I mean, Congress doesn't always has done investment decisions for transportation infrastructure that all we do is if there are certain effects on the economy that are not in line with our mandate, then we'll respond to it. That's it. I mean, this is nothing new. Investment in has always happened from the government, and I've always responded the same.
Thank you. Governor, you also mentioned how in this time of emergency during COVID, as in past emergencies, there were new facilities, new lending programs set up where the Fed was working very closely with the Treasury or was implementing things, as you said, backstopped by the Treasury and the Congress. What happens when or if the Congress or the Treasury wants to extend these programs lifetime beyond what you or your colleagues would consider the crisis period? Is that a threat to central bank independence if, say, the Main Street program is extended beyond the crisis?
Well, we'd have to ask why you would want to do that. I mean, these are always intended to be emergency facilities. Presumably when an emergency is over, you put the facilities away. Extending it beyond that would then say we would like this to be somehow part of your standard policy toolkit. And that would be something you would have to sit down and have a discussion about. Why would you want us to do that? Particularly if they took on the policies of credit allocation, which we have tried very hard to stay out of that. We don't want to be picking winners and losers in society over who gets credit and who doesn't. So there would really have to be a discussion for why Congress would want to do that, have us do that, as opposed to having the Treasury or the Congress do it directly.
You've set this out very clearly and cleanly. And as you said, I mean, it's your view, but it's also consistent with things Chair Powell and others have expressed. But in the applied economics sphere, there have been a number of proposals in recent years for much more complicated interactions or formalized interactions between fiscal and monetary authorities. Former Fed Vice Chair Stanley Fischer co-authored one from the BlackRock Investment Institute a couple of years ago. The 2021 Geneva report from CEPR goes into fiscal monetary interactions. Is there anything to learn from these proposals? Are these kinds of conditional arrangements or contracts a useful thing for people to be thinking about?
Yeah, so I have briefly read both of these proposals, so I'm not going to claim my understanding is perfect. But as I understand these proposals, these things involve either the central bank taking over what we might call fiscal actions, helicopter drops of money, which many people interpret as a fiscal policy action, or having the Treasury take over central bank functions, such as price level targeting or inflation targeting. So these proposals start mixing the roles of central bank and Treasury operations. Now, back in the days of when a lot of us, you included, were doing research on central bank independence, there was kind of a view that for bad enough shocks, it actually was optimal to suspend central bank independence, have the political authorities take over policy, and then when things settle down, restore policy back to the independent central bank. So that kind of idea of kind of suspending things and having the central bank behave differently during really severe crisis kind of was thought about a long time ago. And in a way, you can argue this is what happened in World War II. The problem in all of these proposals, including that one I just described, is committing to a time or state of the world where power is transferred back to the central bank. That's the weak link. It's easy in an economic model to say, if X happens, power goes back to the central banks. In reality, it's a lot harder to do that, okay? And one of the issues, and this is related to research I've done over my career, is that, in those proposals, the fiscal political authority is a monolithic body with one set of objectives that are perfectly consistent with the objectives of the central bank. But in reality, this is typically not the case, since we have different parties in power that have different objectives. And as a result, these parties may differ on terms of when the appropriate transfer of power should go back to the central bank. So there's some uncertainty about when that would be acceptable, depending on who was in power, what their views were of the appropriate timing. So that would create some unnecessary political uncertainty in terms of determining monetary policy.
You had mentioned when you started your remarks that there is this sort of drumbeat. I don't want to exaggerate it, but it's definitely there, of people expressing in the markets, in various online fora, expressing concern about the Fed taking a role in what you referred to as debt financing. At the same time, we've seen actually the Fed be viewed quite positively over the past year in terms of polling data, relatively light criticism as opposed to previous years in handling congressional testimony. I mean, leaving aside whatever skills Chair Powell and others appearing before congressional committees, as you will, have in this matter, I mean, what do you think has made this better political context for the Fed, or more favorable political context for the Fed in the last couple of years? Because QE was very controversial a few years ago. FX swaps, which were used to, I think, great effect a year ago, were very controversial last time around. What do you think has changed?
Well, I think you actually have to ask Congress, since it's their opinion. But my impression from meeting with members of Congress over the last year is that they really value and respect Fed independence. It's viewed as a good thing for the economy, households, and businesses. Now, particular policies, maybe how we go about doing some things, may create some controversy, but nobody would say get rid of central bank independence because of maybe FX swaps policy. Now, I would say also potentially the reason for a positive outlook is that in the COVID crisis, we did our job and we did it well. And so performing as people expect helps a lot. But it's also important that we're accountable to Congress. Chair Powell has had to go up and testify in front of Congress in terms of how we did with the facilities. That's good. I mean, that is what we should do. So, and I think the last thing is this crisis was very different from the last one in that this was really a natural disaster. And in a natural disaster, you're just trying to get help to everybody as fast as you can to try to save lives and damage to the economy. That's much easier for people to rally around than if it comes down to the 2007-8, where it's viewed as to generate financial stability, you had to bail out a bunch of bad actors. That really upsets people. It's like, there's a problem, you're trying to fix it, but at the same time, you're bailing people out. So I think the financial crisis had policy implications that didn't seem to quite hold this time because of the nature of the shock.
Thank you for sharing your view on that. If I could, one final question on the central bank independence fiscal interaction point. Two fellow central banks, the Bank of Japan and the Reserve Bank of Australia, have undertaken what's called yield curve control, where their operational target is a target for the level of interest rate on a specified government bond. For several years now, in Japan, that's been the 10-year government bond. For the last couple of years in Australia, that's been the 3-year government bond. Do you see this as a policy tool that compromises central bank independence, or is this just another piece of policy toolkit that can be used under certain circumstances? And the Fed, or I should say the FOMC, it's very clearly said they haven't ruled out yield curve control, although it's not currently under discussion as an option. Under, broadly speaking, general circumstances, when is something like yield curve control useful?
Yeah, I think our current tools are working well, and we pretty much focused on those tools. If you look back at the minutes of the June and July FOMC meetings, there was an extensive discussion by the committee on yield curve control. I wasn't on the FOMC at the time, but I was at these meetings as research director from the St. Louis Fed. And nearly all of the participants indicated that there were a lot of questions regarding the cost and benefits of this approach. This was one of them, potentially losing control of central bank independence, losing control of our balance sheet. Exit policy is, as we were just talking about, exit policies from anything where you have this kind of interest rate control for longer term yields and whatnot. Exit policies is a very serious concern. So we felt like the tools we have are doing the job, and there was no reason to go into yield curve control. It obviously is a tool that's potentially sitting there, but there's a lot of tools in toolboxes you don't necessarily need to pull out unless you really had to for some reason. And as I think Chair Powell has said, if we saw a lot of disorderly performance in longer term yield markets, we might have to step in just for financial stability reasons once again. But right now, the movements in yields pretty clearly are showing that the market has a very good sense that the U.S. economy is recovering, and that this is actually a good sign. And it doesn't appear to be; they don't appear to be going up in a bad fashion. They're going up. The economy is improving. That's good. That's what should happen when an economy improves. And the last thing we'd want to do is necessarily stop that from happening, since it's kind of reflecting a good performance of the economy.
Great, thank you. Turning now to current monetary policy issues, because of course you are now a voting member of the FOMC. You mentioned the new strategic framework for the monetary policy that Chair Powell and others announced last August, and Vice Chair Clarida discussed with Peterson shortly thereafter. So you were in the room for those discussions. You were not a member of those discussions previously, as you said. What do you think the new framework means in terms of differences on decisions to hike rates than it would have been in past cycles? I mean, what would constitute a demonstration of this framework's success as opposed to what was in place before the current framework?
Yeah, so one thing I really would like to stress is that our framework doesn't speak to rate hikes. The framework provides the criteria for looking forward, and it's outcome based in terms of when we think we will achieve our dual mandate. For rate hikes, that information would come out of the FOMC statement. And that will give guidance down the road on the path of rate hikes when the time comes. But we're a long ways from raising rates at this point.
We are hearing a lot of talk about overheating, including from people like my colleague, Olivier Blanchard at the Peterson Institute, our board vice chair, Larry Summers, and not just them. To be sort of blunt about it, what to you would constitute overheating? What would you be looking at? Is it labor markets? Is it PCE deflator? Is it bubbles in financial markets? Or is overheating a concept you're not looking at all?
Yeah, that's a great question. I've been asking that to myself lately whenever I use the word. As I thought about it, as I'm going to put my academic kind of hat on, and the concept of overheating is a very Keynesian concept. It doesn't really exist in other types of macro models that you learn in graduate school, such as a real business cycle model or overlapping generations model, or Diamond Mortensen Pissari's labor search models. And the main difference between those models is they don't have inflation in them. So any discussion of overheating to me seems to be, it has to be tied to inflation somehow. Now, one way I would worry about, as we said in our new framework, we're not worried about inflation going above our 2% target for a period of time. What I would be concerned is if somehow inflation expectations appeared to suddenly become unanchored to the upside. Then I would think that would signal something about overheating. Now, bubbles are always a tricky problem. I don't know if they're really overheating. I don't know if the fact that Bitcoin goes above 50,000 is a signal the economy's overheating or not. That's the problem with individual assets. People like to point at them and say things, but it's very hard to claim that these individual assets are creating anything. If we saw something more across the spectrum in assets, then if we really thought there was a problem, we could use our supervisory tools to guard against those risks. But currently, banks are resilient, strong capital, liquidity levels, everything seems to be going well. We have a financial stability group at the Fed that pays attention to this, keeps an eye on it. We're not seeing red signs flashing or warning. So that's pretty much the way I would think about overheating. It's really a question whether inflation expectations start to become unanchored and start drifting up more than we would think is acceptable.
Do you get concerned that if, consistent with some understandings of the Fed's new framework in the current situation, inflation is above target for a couple of years, say, that will unanchor inflation expectations, or is that something that we can wait to see what happens?
Yeah, I would think that, one of my preferred ways is kind of, and I mean, there's a variety of measures of inflation expectations from market-based to survey-based. I like to look at the TIPS, the 5-year and the 5-year forward. And what we've seen is the 5 years have kind of gone up to about 2.5%, but the 5-year forwards are still down around 2.2 or a little less. Those are on a CPI based, whereas our target is PCE based inflation. So to me, that gives some signal that the markets expect us to allow some inflation overshooting, but they don't expect it out into the future. And that's the critical thing. That's okay for expectations in the short run to come up, but we don't want long run expectations unanchored. So that's, I think, a distinction that people need to make is there's nothing wrong with short-term inflation expectations. It's more the longer-term ones that become unanchored that you worry about.
Thank you, Governor Waller. You've been very forthright and obviously talking on to many of the key topics today of the day, particularly starting with your remarks on central bank independence in the current fiscal and we hope coming post-crisis context. If I could just ask one last question, since I believe we have 2.5 minutes left. What you mentioned at the very start, the asset purchase program and the accumulation of the large Fed balance sheet in U.S. Treasuries and similar assets. Fed St. Louis, including under your directorship of the research program, was long associated with interests in the balance sheet and monetary aggregates and so on. Should we be worried that this accumulation of assets on the Fed's balance sheet represents some kind of flood of liquidity that eventually will come back, or is it all just a bygone, the stuff sitting on the balance sheet now?
Yeah, it's interesting when I think back to monetarist type prescriptions from Milton Friedman. He always talked about inflation as the money growth rate, not the size of the central bank's balance sheet. As far as I know in economics, there's no theory that tells us what the optimal size of a central bank balance sheet should be. I do know that Friedman advocated that we have enough reserves in the system so that banks were basically indifferent between holding reserves or other safe assets in the economy. That's the classic Friedman rule. So you do want to have a lot of reserves in the system for liquidity reasons and not make liquidity scarce, since we can create liquidity at zero cost. So in that sense, I'm not too worried that the reserves, and Friedman said, the size of the balance sheet, the size of reserves is really indeterminate at that point. It could be large or it could be relatively, maybe small. So I'm not particularly worried. Plus we have the ability, if we thought the reserves were going to create a problem, we have the ability to pull the reserves back out. We started to do that back in 2015, 16, 17. We were letting our balance sheets start to unwind these positions just by letting the maturities run off and not replacing them. So if we saw a problem with the size of our balance sheet, we could always take actions to pull those reserves back out of the system without too much problem.
Terrific. Well, thank you again. We are very privileged to have had Governor Christopher Waller give his first public speech as a member of the Board of Governors here at the Peterson Institute today, at least virtually. And very important remarks on the issues of central bank independence in this fiscal and crisis context. We look forward to welcoming Governor Waller back in future and welcoming as much of this audience or more tomorrow for remarks at 9 a.m. Eastern Time by Vice Chair Randall Quarles of the Board of Governors in his role as Chair of the Financial Stability Board. This meeting is adjourned.
Thank you, Adam. I appreciate it.
Thank you, Chris.